So the chapter cost of capital. So we should understand what is capital. Capital is a money. What is that? It is a money that is required to start, expand, even to run the business. So there is a cost of capital. So that is capital. So but capital, from where we do get capital? We get capital through loans, debentures, and shares. Cost of capital, money. Okay, loans, debentures, and shares. The thing is, then what is the cost of capital? When we are borrowing the money through loans or debentures or shares, we need to pay certain return. We need to pay a certain amount. And that amount is called as a return. It's called as a minimum return. Minimum return that a company, yes, a company has to earn. The company has to earn. Why it has to earn? It has to earn to maintain or increase the market price of share. The market price of shares. So it's very easy. What is capital? Capital is a money. Capital is a money. And why it is required? To start, expand, and run. And what form? Loans, debentures, and shares. And to get the money in this form, you need to pay a certain amount that is called minimum return. So what is cost of capital? Cost of capital is the minimum return that the company has to earn to maintain or increase the market price or market value of shares. Okay, understood? There are two types of cost of capital. The first, cost of debt, and next the second one, cost of equity. So let us understand first what is cost of debt. When you borrow the money, that is the capital, through loan, debentures, bonds, etc., that is called as a debt, and on that you need to pay a fixed interest. What do you pay? A fixed interest. You need to pay interest whether you're getting profit or loss. Irrespective of anything, you need to pay a interest. That is why the cost of debt is the amount of interest you pay. But on the other hand, equity share, that is the second one. The second cost of capital refers to the expected return or the returns that is expected by the shareholders. Expected returns or the return expected by the shareholders, by the equity shareholders. Why? Because unlike debt, in equity you do not pay interest. So what do you pay? And you pay dividend, but dividend is not mandatory. Okay, then what is it that is the cost of equity? The cost of equity is the returns expected by the shareholders on the amount that these people have invested in the company. The question rises, why we paid the fixed interest here and not here? Because who provides debt? They are lenders. And who invest through equity or owners? Simple as that. Cost of debt, cost of equity. Cost of debt is in the form of loans, debentures and bonds, and they carry fixed interest, and that becomes the cost of debt. Whereas the equity, it is an expected return, the return that is expected by the equity shareholder on the investment they have made. It doesn't have any interest, dividend is not compulsory. What they want the increase in the market value, increase in the market value of the shares, because they have taken risk by investing in the company. As we have learned about cost of capital, there are two types of cost of capital. One is the cost of debt. Cost of debt can be calculated in two ways. One is irredeemable and the second is redeemable. So the formula goes like this: KDB. K is cost of debenture before tax. That is I divided by P. But when it has premium or discount, it is written as I divided by NP. But when there is a tax, this is written as I divided by NP 1 minus T. This point, and for this before tax, KDB is equals to I plus 1 by N, open the bracket, RV minus NP whole divided by 1 by 2 RV plus NP. But what about when there is a tax? KDA, that is after tax, is equals to I 1 minus T, close the bracket, plus 1 by N, same, RV minus NP whole divided by half RV plus NP. Now the question is, what all these alphabet express, what they denote. Let us see. So I is interest, P is principal, NP is net proceeds, N is number of years, RV redeemable value of debt is net proceeds of debenture, T is tax rate. Now let us calculate the cost of equity. We have seen the cost of debt. There are two types. In the cost of equity also, you have two types. The first type is dividend yield method. Dividend yield method. And the second type is the B1. The second type is dividend yield plus growth method. Dividend yield plus growth method. So let us quickly see what is the formula. KE. KE denotes the cost of equity. KE is equals to D divided by NP or D divided by MP. This is for dividend yield method. What about the dividend growth method? We have again cost of debt is equals to KE is equals to, we have D1 divided by NP, not MP, NP plus G, or you have KE is equals to D0, okay, 1 plus G, both the G's are same, divided by NP plus G. Okay, denotes cost of equity. D is expected dividend per share. NP net proceeds per share. MP market price per share. D1 expected dividend per share at the end of the year. D0 previous year's dividend. This is D0, okay, previous year's dividend. G or big G, I mean capital G or small g, growth rate in dividend.